Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey, welcome back to ETF Spotlight. I'm Daniel Snyder. Today is a real treat. We are joined by Emma Johnston, who is a quant strategist here on the Alpha Picks team at Seeking Alpha. She spent years over at State Street Global Advisors. She used to write as an analyst on Seeking Alpha as well, and she knows everything international ETFs. That's why we're so excited to bring her to you here today. Emma, thank you for jumping on the program.
Thank you so much, Daniel. Thrilled to be here.
Yeah, so I'm thinking about what every investor's thinking about. We're coming off of a week where Europe just seemed to dominate headlines. Obviously, pullback in the markets in the US on Friday. We're all looking at China and international areas like Argentina as well this year. I mean, this is complete focus on international equities compared to US right now. And so we all just need to dive into your knowledge base of why international ETFs and why might they be right for investors?
Totally. It is a fascinating time to be thinking about international ETFs. We saw the markets blink last Friday. An episode of Wall Street Breakfast was on why is the right time to invest in Europe at the moment. That happened last Friday as well. And so I wanted to talk a little bit about international ETFs because it's a big, exciting space. The way they slice and dice international ETFs is pretty complex. And so I just wanted to share a little bit of my knowledge about how I think about international ETFs. You know, they offer quite a bit of the same benefits as US-based ETFs in terms of their diversification, but they tend to offer some growth opportunities as well. You can target some of the fastest growing economies in the world, which are outside of the US at the moment. They offer some indirect currency benefits, can act as a natural hedge when the dollar weakens. And they're, traditionally lower cost compared to other foreign direct investment. And, there's always potential dividend income opportunities with these international ETFs.
So when it comes to focusing on specific countries, I think one that kind of took over the headlines for months now is Argentina. So if an investor was going, okay, at this moment in time, I want to focus on Argentina, which ETF might I be able to use if you don't want direct stock exposure?
Totally. So ARGT has come to dominate headlines. That's the only US listed Argentina focused ETF. And this is what we'd call a single country ETF, where it really provides this narrow exposure to a specific market. Argentina is a super high growth market in Latin America, and ARGT has had a banner year. They've returned over 70% on a trailing 1 year basis. It's an ETF that's been able to gain traction. It's got an AUM of over $1 billion, which is pretty decently sized for an international or an emerging market ETF. That provides investors ample liquidity and an opportunity to invest in some really interesting companies in the Argentine market. I don't know if folks are familiar with the background there, but sort of what spurred some of the catalyst for the growth in the last year was the election of their president, Javier Milei. I believe he was elected at the end of 2023, and he's implemented some ultra-liberalized economic policies in Argentina. They've had a 30% reduction in real government spending that has led to a budget surplus. And they've had a dramatic reduction in inflation, which is something that's long plagued Argentina. So that is really exciting for investors who want to make a play on an emerging market in Latin America.
So besides Latin America, as we had mentioned here at the beginning of the episode, Europe seems to be dominating headlines. And somebody might be looking to grab a little exposure in these developed markets. So from a developed market standpoint, is there an ETF that comes to mind?
Yeah, absolutely. So my favorite is AIFA. This is a broad-based developed markets exposure. That acronym, which is a little weird to say, quite a few vowels, it stands for Europe, Far East, and Australia. So you're getting exposure to major players in the European market, as well as Japan, which is the third largest economy in the world, and Australia. So there's a few different benefits there. Obviously, developed markets, little less risk, but you're also getting indirect exposure to multiple currencies when you make that play. So ARGT, you're very exposed to the Argentine peso, but AIFA, you're getting a nice blend of currencies there, as well as different economic growth trajectories and quite a bit more diversification. You know, you've got upwards of north of 2,000 stocks in that ETF. So significantly more diversified than ARGT, which I believe is about 25%, or excuse me, 25 individual holdings. But that's something we would expect when we compare these broad-based regional ETFs to a single country ETF. They both have different benefits and deficiencies. So AIFA is a great opportunity to access, you know, about 25% Japan, 15% UK, 10% France. So lots of exciting stuff going on there.
So we've laid the groundwork here for two different ETFs, and you had mentioned the word risk. And as investors, we all want to manage our risk. So what should we know about the risk of these two ETFs?
Totally. I mean, I really recommend when folks are getting interested in internationally investing via ETFs to look under the hood. And what are the core things I think about? Well, I want to think about AUM, right? I want to know how many investors trust this investment play, and AUM is a reflection of that. It also indirectly signifies how much liquidity you're going to have there. Larger AUM typically means narrower bid-ask spreads, which you're getting a better price on the trade if you've got a narrower bid-ask spread. So obviously, I would expect AIFA to have a much higher AUM. I'm not worried about that $1 billion AUM for ARGT, but that's certainly something I think about. And then, of course, with ETFs, you got to think about costs. AIFA is an ultra low cost ETF trading about 7 basis points, whereas ARGT is about 70 bips. Again, I'm not too alarmed about that. That is the difference between a single country exposure, which is a much more niche ETF. They typically the managers have to pay higher fees to the indexers who are creating those benchmarks for those funds. So expense ratio is a huge thing. I know those aren't risks specifically, but you really want to think about liquidity, which is average daily volume. So, and we typically look at that on a 3-month average. Higher average daily volume is a better indicator. So people are moving in and out of that more frequently. And we certainly see that with ARGT. They've got a 3-month average daily volume of about $38 million, which is very decent for an international single country ETF. And AIFA's is massive. AIFA has an average daily dollar volume of about 643 million, which is well above what we'd see for the median ETF.
Yeah, that's incredible. Now, in the notes here, it says you also focus on the volatility aspect of these ETFs. What are we looking at here with this standard deviation numbers that you focus on?
Yeah, so these are critical risk indicators for an ETF. They're basically measuring the daily price fluctuations for a given ETF. And again, unexpectedly, we see a much higher standard deviation for ARGT. This is typically the trade-off you see for those massive returns, right? There's always a trade-off. You want to balance your risk with your opportunity for upside. And so ARGT's standard deviation is about 25, not great, significantly higher for the median of all ETFs. But again, that's basically the price you pay for that 70% return we've seen over the last year. AIFA is much lower. Their standard deviation is only about 13, and that's compared to 12.5 for the median of all ETFs. So that is trading in line with median ETFs, and you're getting diversified, broader market exposure there. So I think that's a pretty decent trade-off for a time when investing in developed international markets. It's probably prudent to start thinking about that, as we've seen the market start to flinch a little bit in the US.
Now, to go back real quick and focus on the currency aspect, right, which I think is a major player when you start looking to overseas. And obviously, we see how much the makeup of other countries are for revenue for the S&P 500, right? But when we're watching the strong dollar, as it is right now, I'm looking at the dollar index is above 106. It popped after the, when did it start? It looked like it started October of 2024 when the dollar this massive strength come into play. So are we expecting a weaker dollar ahead in that benefits international? Is it vice versa? What's the play there?
I mean, it seems like we're on a path to monetary easing has been paused. So I don't anticipate the dollar to weaken against these international currencies anytime soon. But like a lot of, ETFs, these are passive long-term investments, and they're really seen as a hedge over time, right? So as those kind of incremental shifts in the dollar, weakens, it strengthens, etc., you're really just providing an embedded hedge via that ETF to help protect against those fluctuations and how that impacts investments in real dollar terms over a 3 to 5 year period, right? So I'm not as worried about the short term, but over the long term, I like what this provides me.
Gotcha. So this IEFA ETF that we've been focusing on today obviously covers a couple different countries, as you mentioned. So I think some investors get kind of stuck up on, Japan and what Japan is now doing by raising their interest rates for the first time in an extremely long time, where people used to go and do currency conversions and the carry trade, which some people might know about. How much should investors be focusing on one country within an ETF like that?
Yeah, I mean, again, back to my recommendation for looking under the hood, you can see it as a 25% exposure to Japan, but that is also complemented by a 15% exposure to the UK and 10% to France. So you have, the specific machinations that are going on with those individual European countries that are going to impact, returns, and obviously they have currency implications. But I actually think that 25% is that's a good number. I like that you have exposure to a country that their currency is likely to appreciate with their in the coming year, and that'll help in terms of U.S. dollar terms as it weakens. So I really see it as a benefit and not a deficiency.
I don't see anything about China on here. Why not China? People have been focused on what's been happening in that country, the real estate crash they had, the look for potential surplus coming. And we have famous fund managers, I believe it was David Tepper, who came out and just said, buy everything in China. So why not China?
China's, these are not either or choices, right? So I see AIFA, this is what I would call a complement to a core allocation. If you're entirely in the S&P 500 for your core allocation, right, which usually represents about 60 to 80% of your portfolio, and you want to dock that back a little bit, AIFA is like a decent substitute. It's all these diversified emerging markets that have pretty stable economies. Their political situations are, a mix of shaky to stable, but, similar situations all over the world. China is more, that is a massive economy and really important exposure to have, but that's a single country play. So that is why it's kept out of AIFA, right? It is not yet cleared the benchmark to be considered a developed market, and it kind of stands alone in its own space, probably more analogous to ARGT. But again, this is the difficult thing, and why I always recommend, drill into these ETFs, see what the country holdings are, the sector holdings, and how much of the, the top 10 holdings are in a given company, because you can really end up having a much more narrow exposure than you would have previously anticipated. So China is down, it's not out. It's just not what I would consider part of this core allocation.
All right, Emma, let's go ahead and wrap it up there. Thank you so much for joining us on the program. Obviously, everybody that's been watching, I'm sure, appreciates it as well. And again, everyone, Emma Johnston, Quant Strategist here at Seeking Alpha for Alpha Picks, and we'll see you here in the next episode soon.
Great to talk to you today, Daniel. Take care.